Hello, my name is LJ Stambuk. I'm the President and CEO of the World Affairs Council of Charlotte. It is my great pleasure and delight to have with us today Dr. Jay Bryson. You might recall that we have had this program with Dr. Jay Bryson for 14 years running. It's an annual program. It is one of our premier programs and one that I personally enjoy very, very, very much because we do learn a lot in our conversation with Dr. Bryson. Dr. Jay Bryson is a managing director of Wells Fargo, and as you might know, the World Affairs Council of Charlotte is the community's premier global education, nonprofit, nonpartisan organization. We have always sought to bring the world closer to you and to build a community of internationally informed and engaged citizens. Dialogue, knowledge, active participation, and an understanding of global issues are vitally important for our democracy to flourish at all levels. It is my pleasure to introduce Dr. Deborah Bosley. Jesse.
Thanks to WACC for this opportunity and for the good work that they do in our community. So see that list of slides on the documents on my slides? In the past week, did you have to read one or sign one or even try to understand one? Did you stop not because it was boring, you didn't get far enough to know, but because you were overwhelmed with the content? I like to say that I have read and agree is the biggest lie in America. And after trying to plow through that dense content, what was your impression of the company that sent this to you? That's exactly how your customers and employees feel, especially these days we're overwhelmed with confusing content. And frankly, that doesn't make me trust the company or believe their word, transparency. Complex documents like these cause employees and customers to lose trust for you and to lose money and time. A recent study of 400 companies with more than 100,000 employees lost on average $62 million annually because of poor communication. Not to mention the costly legal consequence if you don't meet the regulatory requirements for plain language. The Plain Language Group can help. We work primarily with Fortune 500 companies to revise written communication into clear, concise, and credible content that customers and employees can easily understand and that exceed regulatory requirements. So the next time you or your customers receive some of these necessary documents, let's make sure that they understand them. They'll breathe a huge sigh of relief, and so will you. Thank you.
Thank you, Deborah. Our thanks to the presenting sponsor, the Plain Language Group, for supporting today's program. Thank you, Deborah. Really appreciate it. A couple of housekeeping points. Your microphone will be on mute and your camera will be turned off for the duration of this presentation. To submit a question at any time, and we do want you to submit your questions, please use the question and answer box in the Zoom toolbar, and it is circled in red. This presentation will be recorded and it will be shared via our World Affairs Council mailing list. So please make sure you're signed up to receive our emails. Thank you. If you're registered to participate in the World Affairs Council members only networking reception after today's program, please stay on the Zoom call once the presentation has ended. Our staff will enable your microphone and camera access, which we ask that you please turn on to participate. This is a new feature of our programming. We invite you to join us, our members, and we will discuss today's program and many other issues for about 30 minutes after we finish with this program. As Charlotte's global education nonprofit, we're proud to continue serving our community. We're very, very, very thankful for your support, and we ask that you consider making a contribution in order to help sustain our vital place in Charlotte's civic landscape It is a very challenging time that we're all going through, and without your support and help, we would not be here today and not have the opportunity to listen to Dr. J. Bryson. So if you're not a member, please become a World Affairs Council member. You can also text, and please, if you can, donate. It is tax deductible up to $600, top line deductible with the new regulations that have just passed in January. Thank you for your support. And if you like the World Affairs Council, please join us on social media. We are on all of the social medias. You can like, share, and follow us as well in that way. Now, it is again my great pleasure to introduce to you for the 14th time, Dr. Jay Bryson, Managing Director and Chief Economist for Wells Fargo Corporate and Investment Bank, a position he has held since August 2018. In this role, Jay leads the economics group, which provides analysis on economic and financial developments in the major economies of the world, as well as forecasts of macroeconomic variables in these economies. Jay was Wells Fargo's global economist between 1998 and 2018. And before joining Wells Fargo in 1998, Jay was an economist in the Division on International Finance at the Federal Reserve Board in Washington, D.C. Jay has also lectured on international economics and macroeconomics at the School for Advanced International Studies at Johns Hopkins University and Georgetown University. Jay has published in academic and popular economic journals, and his comments on the economy regularly appear in the Wall Street Journal, the New York Times, USA Today, and so on. He makes frequent appearances on CNBC and Bloomberg TV, and I saw him many a time. Jay is a member of the American Economic Association and the Charlotte Economics Club. He's also a member of the National Association for Business Economics and served on its board of directors from 2010 to 2013. Jay received his BA and PhD degrees in economics from the University of North Carolina at Chapel Hill. And again, it is my pleasure to have Jay talk to us about the 2021 Global Economic Outlook. Please. We're ready to listen to you, Jay.
Well, thanks, LJ. And I wish for the 14th time we'd be on the top floor of the Wells One Fargo Center, maybe next year. This is a new experience for us all. So what I'm going to talk about is, as LJ just highlighted, is kind of the global economic outlook. I'm going to focus primarily on the United States, Europe, and China. Collectively, those economies make up 60% or so of global GDP. So it's first best approximation of the global economy. But also have a forecast table showing some of our other forecasts for some of the other economies as well. So let's start with the United States. So Jesse, if you can bring up the first slide here, I'd appreciate it. There we go. Okay, so what I'm showing you here is monthly changes in consumer spending in the United States. And this is in real terms. This is inflation adjusted. And clearly the pandemic just blew the scales off of this chart. Before the pandemic, monthly changes were on the order of, a big monthly change would be 1%. Very often it's smaller than that. But as you can see in March and then certainly April, consumer spending in the United States collapsed as we all went into lockdown mode. As we came out of lockdown mode starting in May, spending surged again, as you can see. And then over the last few months, the bars have gotten progressively smaller, but through October at least, they were still positive. In November, spending went down in real terms about 0.4%, which is not unheard of. That's normal. But and tomorrow we'll get the official figures for December. Now, what we got this morning was fourth quarter GDP growth. And so we know what consumer spending did in the quarter of the fourth quarter. And so assuming that the Bureau of Economic Analysis, who compiles these numbers, didn't make any changes to the previous month, what it implies is that real spending in December went down 1% relative to November. That's a pretty big decline. And I think we all know what's kind of happening here. Starting in October, then through November and December, we had another spike in COVID. And so, many states put in new restrictions. And even without the restrictions, spending would probably be weak. I mean, you don't have to be a rocket scientist to know that if there's a pandemic spiking around you, you probably don't want to be out in a restaurant with hundreds of other people who probably aren't wearing masks because they're eating and talking. And so even without restrictions, people would probably self-select not to do some of these sort of activities. And so the point here is we came into the fourth quarter with a fair amount of momentum, but we exited the fourth quarter with very weak momentum. Again, what we know is, or what we can guess, and this will be confirmed tomorrow, is spending in December on a seasonally adjusted basis was actually negative. And we know that if we look at some more high frequency data. So Jesse, if you go to the next chart, what I'm showing you here is, this comes from Google. This is Google data. And this is from tracking people's cell phones and things of that nature. And this is visits to retail and recreation locations. This is an interesting data series because this comes out on a daily sort of basis. And it's drawn relative to a baseline of January of last year. And obviously what you see is in the springtime, visits to retail and recreation locations collapsed. It kind of came back pretty strongly throughout the spring. But if you look more recently in the last few months, there's some volatility here around the holidays and everything. But relative to where we are today, you can see we've trended down in these visits since October. Again, it's a reflection of what's happening with the pandemic. And it's interesting because it's very, very up-to-date sort of data. And then, if you look at where we are, relative to baseline, we're still down 25%. The next chart shows you, here are, again, using very high frequency data. These are people going out to restaurants. This comes from Open Table. The latest data point we have here was just 2 days ago. And again, there's some volatility, kind of around the holidays, but relative to October, as you can see on this chart, people going out to restaurants has come down pretty significantly. And moreover, relative to where we were last January before the pandemic set in, we're down 60% there. And then next chart, please. And then here's just another data point to kind of reinforce what I've been talking about. These are the number of people passing through TSA security. This was through yesterday. And you see it move up kind of right around Christmas. Makes some sense, people kind of traveling around there, but as you can see, it's weakened again recently. So again, the point here is that the economy has lost some momentum, very, very recently. And I mean, it's certainly not like what it was back in March and April when we were locked down. But growth has lost some momentum here in the United States. Next chart, please. Another indication is, here is the monthly changes in employment. I mean, what we saw in March was very, very bad. And then in April, it was unprecedented. Roughly 21 million people lost their jobs, at least on a temporary basis in April. As the economy reopened, we got some unprecedented job gains, 3 million, 5 million. In some of those months as the economy reopened and some of those establishments that were temporarily shuttered came back online. As you can see, the monthly changes have gotten progressively weaker. And then when you look at the December number, and that's the most recent number that we have, jobs, we lost 140,000 jobs in April. So that's the bad news. That was a negative number. The good news, if there is that there was all essentially concentrated in one industry. It was all in the leisure and hospitality industry. About 500,000 jobs disappeared there in December. And then that kind of makes some sense, right? As some restrictions went back into place, restaurants, laid people off, hotels, which have been very weak, were laying some people off as well. And clearly that's, it's a tragedy for people who work in those sorts of places. And I don't want to make light of it. But outside of that, what we did see, which is a little bit surprising in December, was job gains in other sectors of the economy held up, reasonably well. And so, clearly we're not where we were just a few months ago. And, again, I don't want to make light of it. The labor market is very, very weak. But at this point, it seems to be concentrated in some of these most heavily hit sort of sectors of the economy, like bars and restaurants and the travel industry and things of that nature. The January number will print next Friday. And what we know at this point is that will probably also be a weakish sort of number. Now, I don't know if it's as negative as December was, but is probably going to be at best flat in January. So again, another indication that we've lost some momentum, that the economy has stalled again, largely because of some of the COVID things going on in the economy. Next chart. So the big question here is, will we have another fiscal relief package? And I use that word very carefully. I don't call it stimulus, I call it relief. Because what we've seen in these different packages since last March is it's not stimulus in the normal sense of the word. It's really relief. It's a lot of income relief to people or to businesses that have been shut down. It's not stimulating the economy in the normal sense of the word. It's helping hold up the economy. And I'm going to show you a chart in just a few minutes here. I think that will bring that home. But as you can see, earlier this year, the deficit as a percent of GDP went to about over 20% of GDP. We haven't seen anything like that since the Second World War. Now it's temporary as well. I mean, there's two things going on. One is this is the deficit as a percent of GDP. Okay, and so GDP collapsed. The denominator got smaller, so that pushes the ratio up. And then, of course, we had these fiscal relief packages as well, starting with the CARES Act back in, that was signed into law in March. And then most recently, another fiscal relief package that was passed at the end of December. President Biden, the Biden administration has proposed a $1.9 trillion package to follow on to this thing that was just passed in December. Our expectation is there will be more fiscal relief, but we think it's going to be significantly smaller than $1.9 trillion, so probably roughly half. It's probably going to be on the order, we think, of what we saw back in December. Now, some people would say, well, why can't it be all $1.9 trillion? I mean, Democrats control the House, they control the White House, and they control the Senate now. Well, yes, in theory, but those margins in Congress are razor thin. I mean, as you know, in the Senate, it's 50-50 with Vice President Harris casting the deciding vote. And so, in order to pass a big package like this 1.9 trillion, you have to have all senators, all Democratic senators agree to that. They all have to be present to vote on it. And then Vice President Harris would pass the tying vote. And, if you think back to 2017, Republicans controlled the White House, they controlled the House, and they controlled the Senate. And one of the things that they wanted to do, one of the things that they had been wanting to do for 7 years was repeal and replace the Affordable Care Act. And I think we all remember what happened there. 3 or 4 Republican senators visualized by John McCain, thumbs down, it didn't go through. And, so again, we would have to have all 50 Democratic senators agree to this really big package. And if you look at some of the people who are on the more, moderate wing of the Democratic Party, like Senator Joe Manchin from West Virginia, he's already expressed some skepticism about some of the elements of this package. So we do believe it'll eventually get enough support to go through both houses of Congress, that President Biden will eventually sign it, but we think it's going to be significantly smaller than the 1.9 trillion. Ballpark somewhere around $1 trillion. And maybe just for optics from the Republican side, maybe it's a little bit less than that. But that will be something that will also tend to support, not stimulate, but tend to support the economy in the coming months as COVID remains here in the United States. Next chart. Okay, so here's our forecast going forward. So again, the blue bars are history, red bars on the right is our forecast. Again, you just had this unprecedented collapse in real GDP, over 30% at an annualized rate in the second quarter. GDP came roaring back in the third quarter. And the fourth quarter's number, we actually, our estimate going into 8:30 this morning, it actually proved to be spot on the money. Growth was 4% at an annualized rate in the fourth quarter. Keep in mind, though, that even though we've had a really strong third quarter and a solid fourth quarter, the size of the economy today is still 2.5% smaller than what it was pre-pandemic. That's what happens when you have a 30+% collapse. And so we haven't dug out of the hole yet. Dug most of the way out, but not completely out. So if you look at these bars going to the right, we think growth in the first quarter is going to be pretty weak. We don't have a negative number here. It wouldn't be surprising me if we got a small negative number. But we think growth is going to be pretty weak in the first quarter, just because of the momentum or lack thereof that we had coming into the quarter. But as you go forward here, you see these bars get bigger. And what the operating assumption here, and this is an assumption, the operating assumption is that the pandemic does not come spiraling out of control. Now, clearly none of us know that, right? If these other mutations that are occurring become really bad, and God forbid, they're resistant to the vaccines, that's a game changer. But what our assumption here is the pandemic, and I think you know this, in the most recent week or so, the number of COVID cases, although remaining high, it's come down from where it was just a few weeks ago. And so we're assuming it doesn't spiral out of control. We're also assuming that vaccine deployment continues to ramp up going forward. And by spring, moving into the summer sometime, the economy slowly starts to reopen. Now, when we actually get to herd immunity, I don't really know. But with warmer weather coming, people will start to venture outside. They'll be able to eat outside again. And with more of us getting vaccines, the economy will slowly reopen. And we think the second half of the year will be actually quite strong. And then this momentum kind of carries into the first part of next year. And then the numbers start to fade back to more normal sorts of numbers. But near term, we think the economy is still going to remain kind of sluggish. But then things start to pick up as more and more vaccines, become available. But again, it really depends on the pandemic going forward and the rollout of vaccines. And not being an epidemiologist, I just can't answer how that's all going to play out. Next chart. Just real quickly in terms of inflation, you've heard some stories about inflation here. We've got three lines. Focus, if you will, on the middle line. So this is the consumer price index, and the middle line shows us the overall. Actually, what I'm looking at is the core part of the CPI. It excludes food and it excludes energy, not because they're not important. It's just because this shows you the underlying trends. Food and energy prices bounce around. Overall, CPI inflation can be kind of bouncy. So this is the core part. This is the underlying trend, and it accounts for about 80% of overall spending. So it's most of it. So anyway, if you look at the red line, that's the overall core. Right now on a year-over-year basis, you can see that's at 1.4%. And then there's two lines there. The blue line at the top, it just focuses in on services, and that kind of light purple at the bottom just focuses in on goods. Okay, and what you see, if you look at that purple line, is inflation for goods, which actually before the pandemic, it was mild deflation. that's where you've seen some inflation. Now it's only 1% or so. It's hardly inflation at all. But there is strength in the goods producing part of the economy. People have gone out and they've spent a lot on goods, which continue to be produced. The weakness is in services, and I touched on this earlier, restaurants and bars and travel industry, things of that nature. And so if you look at the top line, the blue line, you see there that if you just focus in on services, that inflation rate has come down because of the weakness. And services make up about 2/3 of this. So that's why the red line lies a lot closer to the blue line than it does the purple line. Now, are we going to have inflation going forward? We do expect to see higher inflation later this year. As the economy starts to open up, we do expect to see some higher inflation, and particularly in the goods sector. Particularly in the service producing sector. There's pent-up demand for services. People want to go out to restaurants. And when you think about it, there's been thousands of restaurants that have shut. And so you're going to have smaller supply. You're going to have a big spike in demand later this year when people start going back out to restaurants again. And you could see restaurant prices move higher because of that. But we think it's kind of more of a one-off sort of thing. Inflation's a process. For us to get inflation like we had, not even back to the 1970s, but to the late 1980s, prices need to continue to spiral upwards. And given the fact that the economy is still kind of depressed here, we don't think that's going to happen. So we do think we'll get higher inflation later this year. It's less than, as you can see here, less than 2%. By the fall of this year, maybe you're looking at 2.5%. But that's probably going to be the high water mark for it. So it's hardly an inflationary environment at all. And what that means, if you go to the next chart, is the Federal Reserve is probably on hold for as far as the eye can see. We think the Fed, in terms of its short-term interest rates, we think the Fed's going to be at essentially zero between now and the end of 2022. That's as far as our forecast goes. Put a gun to my head and say, we're talking about 2023, I'd probably say I think the Fed's probably on hold through then as well. And they're probably going to continue to purchase bonds for the foreseeable future as well. And so that we think that keeps a lid at the back end of the yield curve as well. And so in general, we think we're in a we've been in a low interest rate environment. We think that will largely continue for some time. Okay, next chart. All right, let's leave the United States behind. Let's trot on to the rest of the world. Let's start with Europe. So here I'm showing you COVID cases through yesterday in both the Eurozone and the United Kingdom. Obviously, the number of cases in the Eurozone is higher in the United Kingdom, but the Eurozone's population is almost 5 times as greater than the UK. On a per capita basis, the UK has a pretty elevated rate in terms of new COVID cases. But particularly in the UK, you can see that's starting to recede, and it's starting to come down a little bit in the Eurozone. And the reason why is many European countries, both on the continent and in the UK, have put in some restrictions. In the UK, they're actually quite restrictive there in terms of stay-at-home orders and things of that nature. And next chart, what that means is what we're seeing is some significant economic weakness there. So here I'm showing you purchasing manager indices for both the Eurozone, which is the blue line, and the United Kingdom, which is that orange line. And the way this works is when the line is above 50, activity in the service sector tends to be expanding. When it's below 50, it tends to be contracting. And you can see where we are right now. This is from January, so it's very up to date. In both the Eurozone and the United Kingdom, we're well below 50, particularly in the United Kingdom. Now, we're not back to where we were in March and April, but what this leads us to believe is you're probably looking at, so this morning in the United States, we got positive GDP figures, 4% annualized. Don't have the official figures yet in Europe, but we're probably looking at small negative numbers there. Next chart, please. Now, what's interesting in Europe is, and I've got a number of lines here. What I'm showing you is year-on-year changes in household income. And if you look at the top part here, so the blue line would be Canada, orange line is the United States, and the purple line is Australia. What you saw earlier this year is income actually rose significantly in many of these economies. And the reason why is, and I'll just focus on the United States as an example. Here with the CARES Act, part of that was you sent out these $1,200 checks to households. We had these extended and enhanced unemployment benefits. Income in the United States earlier this year popped, not because of wages and salaries, they went down. It's because of all these government programs. You didn't have the same sort of thing in the United Kingdom and in the Eurozone. You had other forms of stimulus, but you didn't have that direct aid to households there. But when you go to the next chart, what you do see, though, is here I'm showing you savings rates. So the circles show you where the savings rates were at the end of 2019, before the pandemic. And then those squares, the light purple squares, show you where they were at the third quarter of last year. That's the latest data that we have. In every case, you can see savings rates came up. So what happened is, in the United States, income went up in the second quarter significantly. Spending collapsed. And so savings is the difference between income and spending. People got all these, for example, $1,200 checks. They had no place to spend it because the economy was shut down. And so savings spiked. And that's a good thing, because it gives people cushion that they can spend in these months. And you also do see it to the same extent in the Eurozone and in the United Kingdom as well. Savings rates went up. Now, they didn't have the big income hit, but people had no place, or the big income boost, but they had no place to spend it. So the savings rates went up, and they still do have cushion there. So, we're looking for negative growth in the UK and the Eurozone, but we're not looking for a complete collapse, because people will fall back on this savings to help support consumer spending in the coming months. And so if you go to the next chart, here I'm showing you GDP growth rates. We'll start in the Eurozone. Don't have the official figures yet, but if you look at that orange bar, it looks like the Eurozone economy contracted about 7% last year. And just put that in perspective, you can see the Great Recession there of 2009. This is significantly worse than that. But we also think that growth in 2021 in the Eurozone is actually going to be pretty strong, on the order of 3% or so, and that will carry over into 2022. So, like the United States, the Eurozone has to get through the next few months or so, but the second half of the year we think will be quite strong, and that will carry in to 2022. And the similar sort of thing in the UK, if you go to the next chart, here the collapse in the UK was even worse, because COVID was even worse in the UK than what it was in most European economies. It'll be slower to recover this year, but then 2022 we think will be actually a pretty decent year there. Okay, let's go to China, which is the next chart. China is where the pandemic started back in January of last year, and the first quarter in China was very, very weak. And you see this from the PMIs. The blue line is the manufacturing PMI. The orange line there is the service sector PMI. Back earlier in last year, you can see extreme weakness there. But China has held up fairly well. And China has had a pretty good track record of keeping the virus relatively contained. It has come back a little bit in some provinces in China, but clearly not to the same extent that it was early last year, and certainly not like what we're seeing in the United States or in Europe. And so, through December, growth in China appears to be pretty strong. And what that means when we look at Chinese GDP forecasts going forward, next chart, is if you look at 2020, the Chinese economy grew only 2%, which is very, very weak given Chinese history recently. But we kind of look for it to kind of come roaring back this year, close to 9%, obviously bouncing off a low base. I mean, I think the way to think about this is last year it grew 2%. This year our forecast is, this round up, we'll call it 10%. The average between 2 and 10 is 6. And that's right in line where China has been recently. So if you smooth through kind of the pandemic, China continues to grow kind of at trend. And as we look at next year, you can see our growth forecast for next year, it's kind of back to that 6% trend. And we think that will probably trend lower in coming years. We don't look for it to collapse by any stretch of the imagination, but we think China will continue to decelerate just as some long-term things take hold there in China. Next chart. Here's on a global basis, if we aggregate everything up. Last year, we know, was very, very weak. Again, you see, you can barely see the global recession of 2009. I mean, this clearly is the worst since arguably the Great Depression in terms of GDP growth, but 2021 should be a much stronger year. That said, even though we have the global economy growing well north of 5%, if you look back 2 decades ago, back between 2004 and 2007, we had a run of 5% sort of numbers. So that's back when China was growing 10% or more per year, back when Russia was growing 9%, back when India was growing 8 or 9%. We just don't think we're going to have those sorts of growth rates. So in 2022, as you can see, we think global GDP growth moves more back to, quote, normal sort of level. Next chart. Here's just for your purposes, and LJ, you folks are certainly welcome to send this deck out to everybody. Just make a PDF of it, please, and send it out. But here are some of our underlying forecasts for some of the other countries that we cover. Next chart. I mean, in terms of one thing to keep in mind in terms of global trade. What I'm showing you here is 2 lines. These are year-over-year growth rates. If you look at the orange line, that's global industrial production. And then the blue line is global trade. And what's interesting, this chart goes back to the early 1990s. And so if you look at the first half of the chart, before the Great Recession, what you notice is that the blue line is growing about twice as fast as the orange line. Back during those 2 decades, global trade grew roughly twice as fast as global economic activity. And this was the age of, there was a number of trade agreements back then. So you start with NAFTA here in North America, but China joining the WTO, many economies that were, quote, behind the Berlin Wall in the 1990s joining the global economy. This was the age of globalization. And so the production process became atomized. Things that were produced entirely here in the United States, some of that was produced in China, or started to be produced here in the United States. It was exported to China, where it was put into a finished good. It was assembled into a finished good and then exported back to the United States. This was just a period of a lot of global trade. And what's interesting, if you look at the period since the Great Recession, those 2 lines are essentially on top of one another. Global trade has grown roughly in line with global economic activity. And we expect that largely to remain, right? We don't think, at best, we've hit an inflection point in globalization, we think. And some people would say we're backtracking on that now. And this would be, a good time for me just to talk about trade policy. We think that the Biden administration will not get rid of the tariffs on China, at least not initially. Now, the rhetoric will get toned down relative to the Trump administration, but we think that the tariffs will remain in place, at least for some time, as negotiating leverage there. We think the rhetoric will get toned down significantly vis-a-vis Europe. But again, I would be very, very surprised to see trade growing faster, significantly faster than industrial production, as it did back in the 90s and the first decade of this century. Next chart. So this just shows our forecast. I talked about the Fed being on hold for the foreseeable future. here's our forecast for central bank policy rates. We think most other major central banks around the world are on hold as well. Nobody's going to be no major central bank is going to be raising rates anytime soon. And then next chart, I think this is probably my final chart. Yeah. What we think is, again, this is the trade weighted value of the dollar. We think the dollar will depreciate modestly going forward. You know, if we're right and global economic activity picks up, that should be a pretty good environment for risk. And when that happens, you do see capital leaving the United States and going to like emerging economies and places like that. Given the fact that we have a modest current account deficit, we think those two factors put some downward pressure on the dollar, but very, very modest, right? I mean, we don't think we're going back to where we were in the earlier part of the decade, you know, with significant dollar weakness. But we do think the dollar will depreciate somewhat. So LJ, that is it for my prepared comments. So let me stop there and see if you've received any questions, and I'd be happy to talk about anything I talked about during the presentation or anything else.
Thank you so very much, Jay. I always admire the way you can explain economics in a way that everyone can understand and give us a sense of what's coming, not only in the US, but around the world. I kind of want to summarize it. I'm understanding that 2021 second half and 2022 looks good around the world based on the charts that you presented. Am I correct?
Yes. Knowing what I know now at 12:42 on January 28th, 2021, I would say that's correct. But as you pointed out to me beforehand, as we were standing in the ceiling of or the top floor of one Wells Fargo center, you know, I was saying something about assuming COVID doesn't, and this was last year, assuming COVID doesn't get out of control. Well, you know,
and you did mention it last year when you had your presentation, and you did say assuming that COVID doesn't. So you were prescient. You had a very good point there, as you always do. So while we encourage our supporters and members and participants to post their questions, let me just use this opportunity to welcome the team from Charlotte Country Day School of Students. Thank you for being here. I'm sure you're getting a great lesson in economics and global economics as you participate in this program. I would also like to welcome all our members and supporters, but members and supporters from other councils around the country that are participating today. And finally, I would like to say thank you and welcome to the board members of the World Affairs Council for participating today. So before we go to the questions from our members, Jay, could you clarify to us what is, at this point, in your view, the consequence of Brexit on the British economy? It's not only the pandemic that's affecting them, which is obviously the largest effect, but what does Brexit mean, and how much will it affect the economy of Great Britain, if you can elaborate on that?
Sure, and I would say it's still somewhat to be determined, just Brexit itself. Now, they did make this, you know, at the end of last year, this agreement with the European Union, but it largely, it's largely in terms of trade in goods. And most trade in goods will be tariff-free and et cetera. They're still trying to figure out what it all means for services. And you think about, well, we don't trade, you know, there's not that much trade in services, and generally that's true. But a big service export of the United Kingdom is the financial services that the City of London provides. You know, all the investment banking fees and the banking revenues and things like, you know, London is, you know, is the financial center of certainly Europe, if not the world. And what we have seen is a number of financial institutions have moved at least some operations from the City of London to other places like Frankfurt or Paris or Amsterdam or Dublin and things of that nature. And so I think, you know, and financial services is a pretty large part of the British economy. It's something like 11% of value added is from the financial services industry there. And so we'll see what happens there in terms of any sorts of agreements. whether the British financial system will continue to have its quote passport or not to allow it free access there. But if it doesn't, that could be, in the long run, could be a very significant hit to, I don't want to say real income, but rather growth in real income. It's not like it's going to cause the British economy to contract, but it probably may not grow as fast as otherwise if you do have some trade impediments there, particularly on the service side. So still to be determined. We'll see.
Thank you, Jay. So I'll go to Frederick Grisset, your former colleague and board member of the World Affairs Council. His question is, China recently became the largest destination for foreign direct investment. How much of this do you think is structural versus temporary, COVID related? Okay, well, first of all, hey, Frederick, thanks for the question and good to hear from you. I think that, so China had a huge acceleration in FDI, certainly before the Great Recession. It ramped up from only a few $1 billion a year to, well north of $100 billion. There's been more of an inflection point recently. And so I don't know how much it's related to COVID, but I do think that you'll see FDI in China in terms of the flows getting smaller per year. Rather than 120, 140, whatever, you're going to be looking at 80, 60, whatever. The stock will remain there. It's not like a lot of companies are just going to dump their assets there. But the new flows into China, I would expect to decelerate. I think there's a number of things going on. The first is wages over the last 10 years in China have come up significantly. So it's no longer the low-cost production center that it once was. That's moved to places like Vietnam and India and et cetera. And then I think there's some real questions about geopolitics as well. Whether there's going to be, I think most of us would recognize that the geopolitical tensions between the United States and China have ramped up in the last number of years, and probably will continue to do so as well. And then there's the whole issue of technology transfer and things of that nature. And so I think that what you're going to see is a lot of Western companies, they're not going to shun China altogether. There's a huge market there in China, but it's not going to be the export platform that it was before, and that you'll see FDI decelerating going into China. Thank you. So that is a lead into this question in some ways. Rohan Paul, a board member of the World Affairs Council, is asking, how successful do you think the Biden administration will be in bringing back manufacturing to the US, including initiatives under his green policies?
So another shout out to Rohan. Hey, good to see you. This is like, a blast from my past, all these former Wells people. I guess what I would, in terms of that is, I've been bullish on American manufacturing for a long period of time. It's easy to sell American manufacturers down the road, but American manufacturers do a great job. However, I have not been bullish on manufacturing employment in the United States. Manufacturers today in the United States do a lot of things very automative. It's all about capital. There's many factories in the United States where there's just a very, very few people out on the factory floor because it's all machines. And so, and you just look long term, industrial production in the United, relative to 1980, and I picked that very carefully, or I should say 1979. Relative to 1979, the amount of goods we produce in the United States has about doubled over that period of time. Since 1979, which was the high watermark for manufacturing employment in our economy is down 40%. Because everything's automated. It's called productivity. And so, whereas I think manufacturing production in the United States will continue to grow, I'm not so sure about manufacturing employment. Yeah, yes, more manufacturers will relocate back to the United States, but they don't need a lot of people to be operating those factories. I don't think we're ever going to see manufacturing employment in this economy back to where it was in 1979. And I'll stress that, ever. We're 40% below where we were in 1979. We're never going back there.
Thank you, Jay. Now a practical question. We all have this question, and Gene is formulating it well. What determines the rapid price changes in retail gasoline prices, which sometimes go up 10 cents in a day and sometimes go down 10 cents a day?
In retail gasoline?
Yes.
It reflects the changing price of crude oil, which is its biggest, the biggest part of the cost base there. You know, crude oil gets pushed around because of different demand factors, supply factors, OPEC, whether they're going to pump us more or less, or things of that nature. So it reflects that. But what I also caution you is people look at, you know, retail prices of gasoline going up maybe 50 cents a gallon over the last few weeks, right? And they say, oh my gosh, this is inflation. No, it's the price of one good moving around. Inflation is when all sorts of goods and services change. And I don't have it off the top of my head, but the amount of what consumers spend on gasoline itself is only like maybe 1% of their total purchases. It's very visible to you. You see it every week, and you see food prices every week. Okay, but that doesn't necessarily mean there's inflation. The biggest part of what consumers spend their money on is housing. And this isn't the way the housing numbers are calculated, but this will kind of give you a sense. And you don't think about this, but if you have a fixed rate mortgage, how much does your mortgage change per month? The answer is it doesn't, right? So if you think about it, there's zero cost there in terms of that housing component. And that's the biggest thing of what you spend your money on. You don't think about that. What you think about is gasoline and food. That's a relatively small part. Housing, right, you don't think about is the big part. And so just because gasoline prices are going up doesn't necessarily mean we're looking at inflation.
There's news out of Switzerland from a skiing resort that there's a new strain of COVID discovered there. They have 16 cases just today. So the question that Tom Eisel has, are fears of the new variant virus strains having any clear economic impact yet? So is there a fear of the new strain affecting the economy?
Not that I can detect, in the data that I am looking at. What I would consider it to be. I mean, we have enough problems right now with the number of COVID cases out there, and that's shutting things down and causing people not to go to restaurants and get on planes and things of that nature. But what I would say is if this strain comes to the United States, like the one from the UK and the one from South Africa, which apparently are here in the United States, and those things are much more transmittable apparently than the Wuhan strain. Okay, if that causes the public health system in the United States to shut down because we're just overwhelmed, as I said earlier, I'll use this word, game changer, right? But I don't know that. I'm not an epidemiologist. So my forecast, or our forecast, is critically dependent on how this pandemic continues to play out from here and the ability to relieve it with vaccines.
Quanta Dawn Light has a question which might be complicated, but I'll nevertheless ask you if you can explain to us. She's asking, what is the percentage distribution of relief funding between large corporations and individual citizens that are, some of them now at poverty level and some even homeless? Is there a distribution, is there a percentage that we can talk about that goes to corporations versus individuals?
Well, I don't have it off the top of my head, but I'm trying to think. So if you think back to the CARES Act, the CARES Act was 2.3 trillion, I think, I can't remember. About 500 billion of that was the PPP loans. And they were given to, the hopes was generally smaller companies, but some larger companies were able to get them as well. In the hopes of, one of the conditions was you had to keep people on your payrolls. And so it went to the company, but then it indirectly went to the workers as well. Other big parts of the CARES Act was these $1,200 checks that went out to most households, the $600 a week payments that went to people who were unemployed, and that went through the end of August. And we did the most recent fiscal relief package. That's $300 a week extra through the end of March. And so many of, and you know, if you think about that chart I showed you earlier, that big spike in income in the second and third quarter, that was going directly to people. So here in the United States, most of the fiscal relief, you know, I'm going to say went actually to people rather than to corporations. Maybe some of it went to corporations initially, but it, you know, that was a conduit to get it to people, you know, to keep them on payrolls. And so the CARES Act and this most recent fiscal relief pact, they were designed and they worked this way to get the economy over the valley of when we were shut down to the other side. And they worked pretty well. And I think a lot of it again went to, you know, households rather than to businesses and corporations.
That is very illuminating. That is a great thing to know. I really appreciate Don asking this question and you responding, Jay. A question: what is your view on the probability of increased personal and corporate income taxes and capital gain taxes, and will it impact consumer behavior and corporate behavior?
So I would say, knowing what I know right now, so first of all, that won't be a priority of the administration until they start doing a budget later this year. And so the fiscal year ends in September of this year. And so if Congress, true to its form, acts as normal, this won't get passed until midnight on September the 30th, and maybe after then, right? You can always do continuing resolutions and things of that nature. President Biden proposed as a candidate to take the corporate tax rate from its current level of 21% to 28%. And he also proposed raising taxes on the highest income individuals in the country. Again, that's going to have to be negotiated with 50 Republican senators in the Senate. Now, what they can do when it comes to this budget stuff, they can fold that into what's called a reconciliation package. And you know, most stuff going through the Senate needs 60 votes to clear a filibuster. When they do this reconciliation, because it's a budget item, all it needs is a majority there. And there's a lot of other rules that go around. I'm not going to get into all technical details, but they potentially could do that. But again, what you would need would be all 50 Democratic senators to be on board with that, and then Vice President Harris to break the tie. And so if you have a senator like a Joe Manchin has become the kingmaker all of a sudden, right? If you have a relatively moderate senator like himself saying, you know what, I'm not in favor of taking corporate income taxes back up to 28%. I'm not in favor of soaking the rich. You know, maybe raising some taxes on the rich here and there, but not soaking them. Then that's what's going to get passed into law. So I think the probability that we'll see next year higher taxes on corporations and higher income individuals, I think the probability of that's over 50%. But what's the probability we have a 28% corporate income tax a year from now? I would say the probability that's pretty low. It's higher than 21, but I don't think it's 28, somewhere in the middle.
We have an interesting questions coming up. Valerie Weiser came with a great question, but it's unfortunately running out of time. So I'll give you a short one, the last question of the day from John McBain. Any comments on Bitcoin going forward as an increasing alternative to fiat money?
I think you'll probably see more and more cryptocurrencies, whether it's Bitcoin or not, becoming more and more of a player. But in the foreseeable future, I just don't see it replacing real money. I mean, what you have to happen is, for that to happen, you have to have many, many corporations issuing, and not only corporations, but the federal government as well, issuing securities in Bitcoin denominated securities. That's how we store our value. You've had some people issuing in that, but it's a trifling amount. And I don't see that changing anytime soon.
Thank you, Jay. Thank you all for joining us for the World Affairs Council's Distinguished Speaker Series with Dr. Jay Bryson, Managing Director and Chief Economist at Wells Fargo Corporate and Investment Bank. And thank you so very much to our presenting sponsor, the Plain Language Group, for supporting today's program. I will turn to the Chairman of the Board of the World Affairs Council, Wayne Cooper. Wayne.
Thank you so much, LJ. I tell you what, it just gets better every year. Jay's been put out, I didn't realize it's been 14 years, but of all the programs, and golly, LJ, y'all put on the best programs in the world, but this one always, year after year, receives the highest marks. And, Jay puts it in a way that even dummies like me can understand a little bit of economics. But I was sitting there thinking, as you was doing your presentation, Jay, that I bet you everybody's was really paying attention this year. It was just such a timely program. Let me give a big thank you and shout out to LJ and all the staff. We kind of don't recognize Charlotte and Jesse and Noah for really making these presentations so professional. I was thinking everything just worked with the slides and everything, and these things just don't happen. Everybody has to work, and I know y'all rehearse and practice, and we thank y'all for that. Before we close, and I'll turn it back over to LJ, but remember that if you're not a member, please join. This is the time when we really, really need our members to step up. And we appreciate all of you, and thank you very much. We'll turn it back over to LJ. Thank you.
Thank you, Mr. Chairman. And let me just say, we don't know what's going to happen this year, but we know for sure what will happen in late January or early February 2022. We will be at Wells Fargo at the top floor, and we will have another conversation with Dr. Jay Bryson on the economy of 2022. So please put it into your calendars. It's going to be great to see each one of you in person again. And Dr. Bryson, thank you so very much to you and Wells Fargo for your support. It's a great event. And for those of you, the members who are staying for our chat group, for our private reception, please stay on. Our great staff, and Wayne, thank you for mentioning Charlotte, Jesse, and Noah. We do have a great team at the World Affairs Council. Charlotte will transfer you into the conversation that will continue on these topics: global economy, U.S. economy, in a special Zoom presentation going on after this one. Again, thank you, Jay. I look forward to seeing you in person soon. Thank you, Deborah. We appreciate your support so very much.